Peterson Institute for International Economics. The acoustics do seem to have improved in here. This is great. I'm Adam Posen, president of the Peterson Institute, and it's my pleasure today to be hosting the launch of our new book by our former senior fellow, Ángel Ubide, The Paradox of Risk, Leaving the Monetary Policy Comfort Zone. I see many friends and colleagues of Ángel in the audience. I'm sure there are more watching online as well as his many fans. I will say a bit more about Ángel at the moment, but just to say that I personally and the Institute as a whole is very excited about this book. As some of you are aware, we held a little conference last week on rethinking macroeconomic policy, and to Angel's credit, he was rethinking one part of that well in advance of our conference. This book is the product of a couple of years' work, very serious work by Ángel, and it challenges, from a real practitioner's point of view, beautifully interlaced with analysis of some of the mindsets that kept central banks, in particular the European Central Bank, from grappling with the problems and during the crisis and in the slow recovery since, as they might have. And as someone who has had my share of beating my head against the wall of fixed ideas in the both central banking and finance minister community, I am very glad to see this. Ángel Ubide is, of course, now a managing director at Goldman Sachs Private Wealth Management Group. Many of you know him as a leading commentator, not just in public, but in many influential private settings, including originally for the Shadow Governing Council of the ECB and the Euro 50 group. He has been at the intersection of financial markets, macroeconomic research, and monetary policy issues for as long as I've known him, which is now going on towards 2 decades. Ángel was with us from 2009 to 2016 formally, and full-time resident from 2014 to 2016, which was while he wrote this book. Again, The Paradox of Risk, buy it now. He is written on monetary policy and European policy issues, on banking issues, on exchange rates. His previous market experience prior to going to Goldman Sachs and being here, he was with the Tudor Investment Corporation from 2001 to 12, with D.E. Shaw from 2012 to 14, and like so many of our good friends, started his economics career after grad school at the International Monetary Fund. Most of all, Ángel is an independent thinker, and that is what we value most. And so by having the benefit of him writing a book, we get to see his independent thoughts brought to fruition with full documentation and having suffered through the full PIIE internal refereeing process. I think he makes a compelling argument for what he calls the paradox of risk, that central bankers have to take on what seems like more risk to reduce the risk to the system. And I will let him explain more about that. Ángel?
Thank you, Adam, and it is a real pleasure to be here, and as Adam said, see so many friends. This has really been a journey more than anything. This is a book that gathers basically everything I know about central banking and markets and economics and politics, what I have learned over the last 15, 20 years. So I hope I'll be able to convince you that you cannot really think about economics without markets. You cannot think about markets without politics. And you cannot think about any of those three without thinking about the interrelation among them. What this book does, and I'm only going to show you a little bit of it in the presentation, it tells you the story of how we got to the crisis, the context, both intellectually, academically, and in some sense the politics. Then what the reaction was from the central bankers and from the policymakers, whether it worked or not, and the lessons for the future. So in some sense, I feel I'm going to be repeating a lot of the things that Olivier and Larry said last week. So apologies in advance for that. But At least when I was looking at their presentation, I thought that I was more or less on the right track. The other thing is, this is a book about monetary policy, but it's really about risk management, right? When you think about economic policy, it's decision-making under uncertainty. And that's exactly the same thing that portfolio managers do when they are facing markets every day. So you think about the outlook, you think about it in a probabilistic sense. Then if you're a policymaker, you decide what policy decision you need in order to change the market pricing. If you're a risk manager, you decide what trade to put on to benefit from that market pricing. But at the end of the day, it's the same process. And this is something I try to put in the book as one of the driving hypotheses. Now, why the paradox of risk? I found that quote from Machiavelli, which opens the book. And I thought that essentially encapsulates what I wanted to say. That is, all courses of action are risky, so prudence is not in avoiding danger, but in calculating risk and acting decisively. And I think that's very important because we come from 40 or 50 years of conservative central bankers and of conservative finance ministers. And the definition of conservative is not necessarily to minimize the risk that you take. The definition of conservative means that you assess the situation and you take the risk that you need to take. And this has been something pervasive since 2007. So when you think about the world being composed of the private sector and the public sector, when the private sector becomes very risk averse, the public sector needs to take risk. And I think that's the main story. And you will see throughout the book that the instances where central bankers or policymakers in general have been willing to take more risk, they have been more successful. And this is a story that I want to tell you a little bit as we move on. Now, one thing that is important also in thinking about markets and the interrelationship with policy making is the power of narratives. And I'm going to try to convince you why I think that's the case. I mean, Rob Shiller has written about this. We just got a Nobel Prize on behavioral economics. Why is this so important? Because if you think about what happened after 2007, there was a big increase in risk aversion. But why? The increase in risk aversion came from three different narratives that essentially hit society at the same time. The first one is that debt is bad. If you think about that, Lehman was about debt, financial debt. The Greek crisis was about public sector debt. But narratives basically simplify a complex reality. So the bottom line was debt is bad, and the reaction to that was fiscal austerity. Now, the second narrative was a more interesting one that maybe you relate to if you are in financial markets, that this is not going to happen again under my watch. And that, nobody saw the crisis coming. And because nobody saw it coming, everybody was panicking that it was not going to happen again and they were not going to miss it. So that led to two things. The first one was a regulatory tightening. No single regulator out there wanted to be accused of not having made sure that the financial sector was robust enough to withstand another Lehman, but also risk managers around the world. I mean, risk management is an exercise in imagination. What you cannot imagine, you cannot hedge. The moment we learned about Lehman, we learned that shocks could be much, much bigger than what we thought until then. And this created, again, another increase in risk aversion in the private sector and an eternal focus on downside risks. The third point was we were used to central banks being perfect. Call it the illusion of control in a behavioral economic sense, but central banks were very good pre-2007 at forecasting growth and inflation to the second decimal point. And all of a sudden we see them that they continue to miss their forecast by big margins. And so there was a lot of commentary about central banks basically don't get it. But not only that, there was the issue of bailouts of banks. And this is, as I call it in the book, the diabolic politics of bank bailouts. You need to rescue banks when the time comes, but the politics are bad. And so all this created the perfect ground for political attacks on central banks, using central banks essentially as the wall behind which everybody hide. And that, in a situation in which confidence was critical for the central bank action, became a headwind. So this is the reason why monetary policy really became the only game in town. This is, by the way, a sentence that comes, I think, comes from Paul Volcker. It's not new to this situation, but essentially central banks were left alone. And this created an environment in which it was much more difficult for central banks to be effective. Now, there is another message I want to give from this book, that is monetary policy has worked. Yes, there is no question. I know there are lots of doubts out there about whether monetary policy has been effective, but the answer is yes. Now, I document in the book the whole extent of research that by now have been developed at all central banks and a lot of academics. It's quite simple. There are two ways of looking at it. Monetary policy affected financial conditions the way we expected. So all the actions, lower interest rates, increased asset prices, and weakened currencies wherever it was needed. And then that also led to higher growth and higher inflation. I also document that in the book, but maybe it's quite simple to think about it. GDP is above the previous peak, and we never suffered deflation. So in fact, we have the puzzle of the missing deflation. But the point I make is that, it could have done better. There are several ways to look at that. One thing I show in the book is the comparison of the policy easing versus standard policy rules. And what that shows is that easing normally came late, and it wasn't as strong as it should have been. Now, part of that was learning by doing, obviously, because all of this was new. But part of that was self-imposed constraints, and I can think of many. I mean, you can think, for example, the ECB decision not to do QE until 2014. That was a decision. That was a self-imposed constraint. We have seen ex post that it was perfectly legal to do. We saw also along the way that the Fed many times thought that the right amount of QE was X, and it did half X. Well, that's a self-imposed constraint. I can understand that instruments were new, but at the same time, when we look at it in hindsight, what we have seen is that there was fear, and there was fear because a lot of the instruments were new, and we had to experiment with them. Now, one lesson I think we can draw from this process is in terms of strategies. When has monetary policy worked well? It has worked well when it has provided insurance on the outlook. In other words, when it has been goal-oriented. Now, this should be obvious, but it is not. Because there have been many times in which we have seen policymakers thinking about the instrument rather than about the goal. For example, it is time to end QE. Why? Because QE feels bad. It is time to raise rates. Why? Because negative real rates feel bad. There is a bit of a morality story that we have been carrying along, and one of the things I try to do in this book is essentially say that, you know what, these are instruments that you are going to be using at the next recession, and you better get used to it. But this has been important. Now, one way to think about this, and I think there is now some incipient research going in this direction by Ricardo Caballero and others, is that when you think about economic decisions, it's essentially a collection of asset pricing decisions, right, by all of us. You might be pricing a financial asset, you might be pricing a house you want to buy, you might be making a decision whether to buy something today or something tomorrow. And that's a combination of your assessment of the outlook plus your conviction about it. And the conviction, I show it there as the uncertainty. So when we live in normal times, think about the great moderation. All that monetary policy needs to do is to fine-tune the outlook, because our conviction is there. It doesn't change. Now, when you have a shock that you have never seen before, or when you are in an environment where you no longer know whether potential growth is going to be the same one as before, or whether the economy is going to be self-stabilizing, as Olivier was mentioning last week, then what dominates the economic decisions is the uncertainty, not the fine-tuning of the outlook. And if policymakers don't come with a goal-oriented policy that says, I am going to ease policy until inflation is at target, then it doesn't work. So think about the difference between the different phases of QE at the Fed, right? QE2 was defined as 600 billion over several months. It didn't really do much. Why? Because we don't know what 600 billion means. Then when you go into a state contingent QE, that is, I'm going to do QE until the outlook looks good, then it's open-ended and then it works. So I think this is one lesson we have learned from the crisis on how to design policy frameworks, that is, do make them state contingent. and make them open-ended. In other words, if you take more risk, because apparently it's going to be very big, you will end up with a situation that is less risky. Now, it's also very important that they are credibly symmetric with respect to the goals. One thing I will show later on, and this is not pandering to Adam, is that the Bank of England has been the most successful central bank among the major central banks. Why? Because it was willing to ease policy when inflation was 5%. They were symmetric. They understood the process. They understood that if you want to stabilize expectations at a level, you have to spend some time above and some time below, and that's absolutely fine. Now, at the time, it was seen as a risky proposition. But that's exactly what this is about. It's about symmetry, and it's about believing in what you are doing. Now, let me talk a little bit about instruments. One thing I discuss in the book is negative interest rates. I discuss all of them, but I think this one is interesting because when you think about interest rates being negative in an economic sense, they make no difference whether they are positive or negative, right? The only thing that matters is real rates in our models. And so initially I started thinking, what is all this big thing about negative interest rates? Why do we worry about it? Then as I was thinking about it and writing the book and time evolved, I changed my mind a little bit. Why? The most important thing from a market standpoint is that interest rates change the reference point. This is also something that you learn in behavioral economics. Think you go to a restaurant and the most expensive thing in the menu is the $40 steak. That makes everything under $40 cheaper, right? If I change the reference point of the $40, I change your perception of everything else. Now, remember when interest rates were not supposed to be negative. They were truncated at 0. So a 10-year bond yielding 2% was seen as yielding too low. The moment you know that negative interest rates are possible, everything changes because then a 2% 10-year rate looks very attractive compared to the possibility that 10-year rates can go to minus 70 basis points. And that's what amplifies QE. So the moment you do QE combined with interest rates that are negative, you open completely the distribution of interest rates and you make it more powerful. Now, could it be too powerful? And that is where at the end, I have started to think, maybe we have too much of a good thing. So Marcus Brunemeyer and others have been talking about the so-called reversal rate. Essentially, what is the concept is that if interest rates are too low or the yield curve is too flat, then the financial sector is going to be in trouble. And if the financial sector is in trouble, it's not going to intermediate credit. So one way you can see, if you look at the figure you have there, it's the red line is the 10-year interest rate in Germany. The blue line is the relative performance of European banks versus the Euro stock, the European stock market. During the period from the beginning of 2015 to 2017, which is when the ECB really went in full force with negative rates and QE, essentially the two lines track each other. So what was happening was the extra easing you were getting from lower rates, it was being offset by doubts about the solvency of the European banking sector. And so this is something that we need to consider. When we think that the bottom in negative interest rates is when the banks start taking the money to the vaults, it may not be true. It may be that the bottom is a little bit higher, because unless we have very, very resilient banks, or you have a banking system for which negative rates is not an issue, for example, everything having variable rates, then you are going to have problems there. Another element that I think it's important, and again, I'm not pandering to Adam, but I think we agree on this, is it just buying safe assets the right way to do QE? So why do central banks buy bonds? Some of them because they cannot buy any other things, and then that's it. But in general, we think about buying government bonds because they are safer, not because they are the most effective way of easing policy, right? So what we do with bonds is to do an indirect way of affecting asset prices, that is via portfolio rebalancing. So we want to buy bonds, so others sell me the bond, and with that money they buy stocks. So the first question is, why not buying the risky assets directly? That is what some central banks have done. And the ECB, to its credit, has been buying all type of riskier assets outside the equities. The Bank of Japan has bought equities. The Fed is the one that is limited by a statute not to buy risky assets. But there is another side effect, that is the scarcity of safe assets in which we live. So what we are doing essentially is the market is demanding safe assets, and the central banks are buying those safe assets that the market wants. So one thing this generates in financial markets is momentum trading. What do? You buy the assets that the central bank buys. It's very easy, right? Because you know they are going to continue to appreciate because there is going to be excess demand. Now, how's this work? What I show you in this chart, these are the cumulative inflows into US ETFs and mutual funds since 2009. Now, you would expect from that chart that if portfolio rebalancing is working, the red line that is bonds would be going down, and the blue line that is equities would be going up. Has gone the other way. So what has happened is that as the Fed was doing QE, the private sector was buying more bonds, and it was fine. It was not really increasing the amount of equities that it was buying. So we need to think about whether the portfolio rebalancing really is a strategy that works. Of course, part of that is due to some institutions that have restrictions, and they must match a benchmark in the amount of bonds that they have and things like that. But when you think about risk, it's not obvious that by buying bonds, you are minimizing the risk to your balance sheet. There is another point that I didn't put in the presentation, but I think is important. Why do we think about the risk a central bank is taking from a fiscal standpoint in one way when it's buying bonds, and in a different way when the central bank is raising rates to trigger a recession to slow down inflation? So what is the fiscal risk of triggering a recession to create, to slow down inflation? It's an increase in the deficit, right? But nobody complains about that. What we complain is whether a central bank is buying bonds that could lose money. So we are being asymmetric again, right, in our consideration about the fiscal risk, because the fiscal risk is not just for the balance sheet of the central bank, right? It's for the consolidated balance sheet of the country. And these are considerations that I think are important when we think about designing policy for the next round. Now, another issue that, if you remember, back in 2007, 8, 9, was all the side effects that all these policies were going to generate, where I'm still looking for them, to be honest. Inflation hasn't accelerated, and if you remember the letter to Bernanke, but all those signatories several years ago saying that we were going to have hyperinflation. So one thing we have learned is that inflation is not really a monetary phenomenon, and especially it's not after we have interest on reserves. So we have separated the link between balance sheets of the central banks and inflation. Fiscal policy has been too tight. It hasn't been too easy. So all those worries about fiscal moral hazard, I think, can be also put to sleep. And it hasn't been a major driver of inequality. And on this, I side really with the central bankers on this. It's true that asset prices have increased more than wages, but what really drives inequality is unemployment. And I think we need to fight that war of making this very clear, because there is still this slide. I know there are many, many times that these issues are going to come and they are going to be repeated. And the next time that central bankers are trying to do something like this, we are going to hear exactly the same criticism that we heard 10 years ago, even if there is no evidence for that. Now, of course, I didn't put anything about financial stability, because that's always something that you better not make forecasts about. But here is one thing. The main channel of policy was reducing risk aversion. So even if there was an increase in risk-taking, that's exactly what we wanted. But then what we see is that equity risk premium remain high. So for all the talk and for all the worries about excessive risk-taking in financial sector and about financial vulnerabilities, what we see is that at the moment, at least looking at equity markets in the major developed economies, you don't see an increase in exuberance that looks out of place. Yes, PE ratios are elevated compared to history, but we shouldn't forget that neutral interest rates are much lower, which is exactly what this chart is trying to show. So can we declare mission accomplished and say that this has been all a happy ride and we should go back to the old days of simply moving interest rates as we were told last week at the conference? I think the answer is no. I think there is no room for complacency. This is a chart I've shown a few times, but I want to show it again. This is the term structure of inflation expectations for the US, there, for the euro area, and for the UK. On the horizontal axis, you have the 1 year, the 1 year in 2 years' time, 1 year inflation, 3 years' time, until 9 years. Those are the levels. The red line is the average of those expectations in 2005, 2006, when we believe we had accomplished price stability. That's for the euro area, that's for the UK. Now, the scale is a bit different, so don't think about the levels. What I want you to think is about where the blue line is versus the red line. So this is in the US. So this is where inflation expectations are anchored today. This is where they were in 2005, 2006. This is for the euro area. And by the way, this is right before the euro area the ECB started to do QE. So you can see really the threat, the downside risk to price stability that was there. That's the UK. So in the UK, inflation expectations are anchored above the levels of 2005, 2006. There are other ways to show that the Bank of England has done the right thing, but I think that's a very convincing one. This is the one place where there are no doubts about the 2% inflation target. And this is what you achieve when you believe in your goals and you behave accordingly. There is another way to look at this, and this is something that surprised me a little bit. So what if we had done price level targeting starting in 1998? Basically, all central banks are around where they want to be. So this is the blue line is the 2% inflation trend. Basically, all of them are there. Now, what happens if you look at core inflation? What we see is that until basically 2007-8, core inflation was tracking a little bit below, and that was perfectly compatible with 2% inflation because we had commodity price inflation, right? Now, what happens there? And ignore a little bit the Bank of England here because there was the impact of sterling that complicates this a little bit. This is the euro area, this is the US. So from the point of view of core inflation, we are tracking well below what a 2% trend would be. Why does that matter? Because if we believe, and that's an if, that commodity prices are not going to have another 200% appreciation over the next 3, 5, 7 years, then you need to achieve your 2% inflation target from core inflation. And that means you will have to run the economy hotter from the point of view of a slack that you did in the previous cycle. And that's a change. We need to get used to unemployment running much below the NAIRU than it did before, because otherwise we are going to have a lot of trouble anchoring inflation expectations at the right place. So it has been a good ride, but there is still plenty of work that we need to do. Now, what have we learned for the future? So let me tell you what I think we have learned. I think we need to design a monetary policy framework that is good for all seasons, for when inflation is high and for when inflation is low. So this is the summary, and then I will go through each of the elements. I think we need a higher inflation target, and the way we get there is with a program of opportunistic reflation. So we don't need to do it all in one shot, but it can take a couple of cycles. I think it's important all central banks adopt dual mandates, de facto or de jure, and I will explain why. But the summary is that at the end, the mandate really becomes maximizing growth subject to price stability. I think it's fine to carry, in fact, it's good to carry large balance sheets at the central banks and operate in all type of assets, obviously properly managed, and if it's lending, properly discounted. I think forward guidance should be cyclically adjusted, and I will explain what I mean by that. And finally, the last point, stop calling these policies unconventional. This is normal, and it's going to be here with us for the next 20 or 30 years. If not, look at Japan. All right, let me go one by one. So what do I mean by a program of opportunistic reflection? So there has been some debate about whether we should have higher inflation targets, right? And you can go, and there are pros, there are cons, but to me, it's very simple. If 2% was the right inflation target back in 1998, which is around when all these targets were designed, and we had the smaller shocks in mind, and we had a higher R star, then it has to follow that 2% is too low today. I mean, it's pure logic. Now, we can say that then the logic we used back then was wrong, and we shouldn't be considering that the inflation target should be enough to minimize the time we spent at the zero bound. That's fine. But if we agree that we want an inflation target that gives us enough room to cut real rates, then we need an inflation target that is a little bit higher. Now, if we don't accept that, then we should be cognizant that what we are saying is we are accepting bigger output gaps in the future, because we are not going to have the same room that we thought we had to cushion recessions. And that's fine, but that's something that society needs to decide, and it should be made clear to people. So there is a trade-off in my mind. Either we have higher inflation targets, or we get ready for more negative interest rates or flatter yield curves that are going to have an impact on the financial sector, or we are willing to accept more active fiscal policy to help monetary policy where monetary policy cannot get to. But we have to accept this, you want to call it trilemma because that's the fashionable word, that's fine. But this is a trade-off we need to accept. And if we don't have an answer for this trade-off, then we are not really doing our job. Now, how do we get there? Because everybody tells me, well, you cannot really get to 2. How are you going to get to a higher level? Well, you do it slowly. We did opportunistic disinflation over 20, 30 years. We can do opportunistic reflation. And I think that is something that it should be clear. So first, you try to overshoot the 2% inflation to anchor the 2% target. And then over a couple of cycles, you accommodate to a new target. Now, people would say, but what about the hard-earned credibility cost of the 2% inflation target? So the Reserve Bank of New Zealand did it about 15 years ago, and it didn't lose any credibility. They moved the target about 100 basis points higher. The Bank of Japan has been doing it for the last 20. If you remember, first it was inflation at 0, then inflation at 1, now it's inflation at 2. I'm not saying they are being terribly successful. They are, more than what many people think, but this is exactly the way you do it. Even the ECB has done it, right? It used to be below 2%, now it's close but below 2%. Hopefully the next step will be 2%, and then you can go slowly. So this is something that I think we need to consider, especially on the trade-off that we are going to be facing there. And this relates, I think, to the issue of adopting dual mandates, at least de facto. And why do I say that? And again, here I borrow from Olivier's paper from last week, but I think, again, it is very close to calling it common sense. If we believe there is a non-zero probability of hysteresis, then demand affects potential growth. And if demand affects potential growth, it's a win-win to stimulate demand. But that implies that you need to focus on the real side of the economy when you do monetary policy. Because with a Phillips curve that is very flat, you could be in a situation where your inflation rate doesn't really move much, and you have a massive output gap. And if you don't react to that, and you only react to your inflation not moving much, you are going to make that massive output gap permanent. And that's not right. But then if the Phillips curve is non-accelerationist, and we have seen it is not, because you have seen big moves in output gaps and very little action in inflation, then the cost of overshooting is very low. Because after a boom, you don't need a bust. All you need is to stabilize growth at potential. So it is difficult to find the downside to this, but again, it's a question of taking the risk. If you want to be very conservative and say, I don't even want to run the risk, then that's fine, but at least we should know what we are saying. There is also an issue of democratic accountability. I remember having discussions, again, with the Bank of England, this time not with Adam, about the thresholds that they put in place. So this is a central bank with an inflation targeting regime that all of a sudden has a threshold on unemployment, in addition to inflation. The beauty of that was that you could talk to people when you went to Birmingham or Bristol or wherever it was about the unemployment rate, not just about inflation. When the unemployment rate in Spain was 26%, I can tell you people in Spain didn't really care whether price stability was being guaranteed or not. They wanted to know that monetary policy was going to lower the unemployment rate one day. And this improves the credibility and the political standing of a central bank. So when we put those things together, I come out with this, that is, the mandate should be maximizing growth subject to price stability. it was very cute to say that price stability would give you maximum growth when we had the divine coincidence, but apparently we don't have the divine coincidence. And so we need to think about this in these terms. And this is not being prone to inflation or anything like that. It's simply making sure that we understand that price stability is the means to an end, that is maximum sustainable growth. Next, why did I say to carry large balance sheets? Well, I think I already made the point before. With IOER, there is no longer a link between the balance sheet size and inflation. But I think there is also this important point of financial stability, that is, with excess reserves, the financial system is going to be more stable. And there are other options if you believe that a large balance sheet is depressing interest rates here or there. There are other things you can do to offset that. But in the bigger scheme of things, we have more instruments to target more specific risk. I'd rather have more tools than fewer tools. Then it's a question of how to use them and how to use them properly. But I don't agree with that view that we need to reduce the balance sheet of central banks to pre-crisis level or close to pre-crisis level because they are interfering with credit allocation. All policy decisions interfere with credit allocation. So this is a bit of a red herring. Next point, cyclically adjusted forward guidance. What do I mean by that? So one thing I've learned, again, going back to what I said at the beginning in markets, is that leverage at the end of the day really depends not on interest rates, but on the level of certainty that you have. So changing interest rate from 2.1 to 2.2 is not going to change the decision to do an operation in markets or in the real economy or whatever. A change in my certainty about what's going to happen, it is going to impact the size of the position that I take. So when there is a lot of uncertainty in the system after a big shock, you want to have forward guidance that is very explicit. And that's what we had from many central banks, right? The Bank of Canada promised rates on hold for a full calendar year. The Fed did considerable periods. The ECB now has similar language. But then what happens when uncertainty starts to decline? Then you need to change your guidance as well, right? And you can get to the other side of it. So at least anybody tells me that I'm very dovish. There is also situations when you can have too low uncertainty and risk attitudes are too exuberant. In those cases, you really want to give minimal forward guidance because what you want to do is limit the extent of carry trades. Right? So when you think about it, it is possible to say that one of the reasons we had what we had in 2007 was the measured pace of the Fed. It made the Fed completely predictable. And when the Fed is very predictable and the path of interest rate is very predictable, then it's very easy to make money in financial markets. And I think this is something important. So what I'm saying here is that sometimes it is welfare improving for central banks to introduce a little bit of uncertainty about the future expected path of interest rates, especially if you worry about carry trades. And carry trades, by the way, I'm not simply talking about hedge funds. It can also be mortgage markets, right? Your decision to buy a house is because you think your variable rate mortgage is not really going to change much. So there are moments in which it's right to give that certainty, and there are moments in which it's not right to give that certainty. The Bank of Canada, for example, now is trying to follow that line. Bank of Canada has decided not to give any forward guidance. It's telling market participants, look at the market, look at the data. Whenever the data is right, I'm going to raise interest rates. And this is a conscious decision they are doing. Why? One of the reasons is they have a small problem with household debt and with house prices in part of Canada. So this is part of the contribution of interest rates, if you want, to macroprudential policy. I made this point, but I'm going to make it again. Please stop calling it unconventional, but also stop calling it exit. We are not exiting from anywhere. You tighten policy or ease policy. But there is no exit. There is nothing negative about buying bonds or about having rates at zero. And I think that's important because there is a stigma to a lot of these policy instruments that we have used. And we want to reduce that stigma for the next time around. So these are my recommendations. Now, as I was writing this book, I realized that the future has basically arrived because a lot of the things that I have recommended are being used. Two examples. One was the Bank of England package after Brexit. What did the Bank of England do after Brexit or right before and after? They did a big easing that included all the elements that I have mentioned before. So there was macroprudential easing, liquidity easing, QE rates, and explicit forward guidance with an insurance. As they said, we are going to use a sledgehammer to crack a nut. And it worked, right? Because if you remember back in 2016, we were very worried about a recession in the United Kingdom in the second half of the year, and it didn't really happen. But the way the package was designed, it was essentially attempting to provide insurance that whatever happened, they were going to be there, and they were going to make sure that inflation and growth were going to be supported. Now, the other element is Abenomics, and I want to say that I'm a big fan of Abenomics. Why do I say that? Because they have concluded that given where they are, fiscal policy has to be in the lead, and monetary policy accompanies fiscal policy, and there is nothing wrong about that. There is nothing wrong about explicit coordination of monetary and fiscal policy. So when the Bank of Japan changed the framework to the yield curve control several months ago, they did an interesting choreography that essentially they waited for the government to announce the new budget so they could announce the following day that they were supporting that and that monetary policy was going to be supporting the new stance of fiscal policy. So this is what we need, right? We need a situation in which if monetary policy admits that it cannot do enough, then we need to find the help of other policies. So here is a question for which I'm not going to give an answer, but central bankers are always very keen to lecture governments in telling them that fiscal policy is too easy and they should be tightening fiscal policy. So should central bankers be as energetic in the other direction? Standing up and saying, I think fiscal policy should be eased, and it should be eased a lot. That's an alternative to helicopter money, right? What we really want is to have the right policy mix. And at the end of the day, inflation is just that. It's an economic policy phenomenon. We are taught in graduate school that inflation depends on monetary policy because we don't know how to solve models in which there is an interest rate and a tax, right? The models at the end of the day are solved for the interest rate. But that's a problem of mechanism design. It's not the way reality works. So I think we need to move forward, if I could add to the conclusions of the conference of last week, to have models where you can have the fiscal and the monetary authority operating at the same time. And think about the pros and cons of explicit coordination and that. And then the last point is obviously income policies, right? If you cannot do it with monetary and fiscal policy, what you need to do is act on wages. Olivier and Adam have been calling for wage increases in Japan. I think central banks should be more forceful on that. And there is nothing wrong about that. So again, it's going back into, you need to abandon your comfort zone where monetary policy was boring, was very easy, and all you had to do was to move interest rates 25 basis points here or there. There is a responsibility that central bankers need to bear. Final point. When I think about all this, I think that, as I said at the beginning, monetary policy is like risk management. Now, I was thinking about that, and there are many behavioral biases that you can find in policymaking. And that is something that needs to be corrected. So, for example, overconfidence. Central bankers have been taking inflation expectations for granted. The anchoring effect, for those of you who don't know, is that you give more weight to the initial observation that you see, right? I tell you a number, and then I ask you, what is the number of the house next door? And the first number I give you provides an anchor. Now, we are hostage to the 1970s inflation. And that is why there is too much worry about inflation. That's an example of the anchoring effect. We are hostage to the Greek crisis, and that's why we give too much weight to fiscal austerity. But there is also the endowment effect, right? The endowment effect is when you own something, you value it more. And that is, I think, why we are overweighting the cost of changing inflation targets, or we are overweighting the cost of changing fiscal rules, for example, in Europe, with the Stability and Growth Pact. Because we own it, we don't want to change it, because we think the cost of changing it is high. Now, when you work in markets, you work with trading coaches, so you don't make those biases, so you don't make those mistakes. And this is important. I think that we need to continue to repeat these issues, so policymakers are going to see that change is needed. And that's my final point, because if we don't do that, we are going to settle for just good enough. And good enough is not going to be good enough for the next recession. So in probabilistic terms, the next recession will come with interest rates very low, inflation low, deficits high, and debt high. Are we going to sit around and say there is nothing we can do? Or are we going to take more risk and try to, all together, put the economy on a better footing? That's what I'm trying to achieve with this. Thank you.
Thank you very much, Ángel. Obviously, I'm pleased with a number of the things you say and agree with a number of the things you say, but it's more important for you to be engaging with the people who might be more skeptical about the things you say. So let me ask a couple questions to get us started and then turn it over to our distinguished audience. The first one is, this is not a core part of your presentation, but it is in the spirit of your presentation in your book, The Paradox of Risk. A lot of central bankers recently and throughout the crisis, particularly in Europe, kept saying, we cannot ease because then the other, whether it's the Greek finance minister, the Italian bank supervisor, the Portuguese structural reformer, if we ease, they will cease to do so. They will cease to do what they're supposed to do. And of course, we saw that in Japan for a long time as well. Mario Draghi, perhaps having read an earlier draft of your book, made a strong statement, I think yesterday or the day before, saying this is not true. QE did not forestall reform. So beyond just saying the endowment effect, why do you think this idea is so persistent? And what do you say to the people of this sort of harsh game theory persuasion that Italy and Greece and Argentina and the US Congress will never behave unless we get tough?
Well, I think it goes back to, I mean, I don't want to repeat this, but it is really a behavioral bias of overweighting a minority of observations, right? So it did happen in a couple of places, and then we think it's going to be repeated all over again, regardless of the evidence. Mm-hmm. And I think the important thing, and I think why it's very important that we continue to do this work of showing the evidence, is that there has been many, many, many instances in which reforms or whatever policy we are thinking about has happened, regardless of what monetary policy is doing. I just think that the problem was we entered the crisis and QE was associated with monetary financing, whether we like it or not. Mm-hmm. This is going to be just making the life of the governments very easy. Some of the magnitudes allow this very easy comparison. Some of the purchases were similar to the amount of the deficit of 1 year or something like that. Well, even if it is, that's not the point. The point is that you want to set monetary policy at the right place so you achieve your mandates. And then what we have seen, that the experience from many other places, is that at the end, the reforms happen. I haven't really seen any policymaker who has gambled its job on moral hazard, with the exception of very few specific crisis situations when it's too late. Mm-hmm. But maybe I'm wrong. Maybe I need to read the literature a little bit more.
No. Second question, as you displayed beautifully in your presentation and is evident in your book, one of your real contributions is bringing some of these market perspectives in confrontation with some of the perceptions. And so to me, one of the most striking charts that you chose to show is the one about bond purchases going up and equity purchases staying flat. Mm-hmm. Now, as you well know, and many of our audience has experienced or actually lives, you can go into conversations with fund managers, with people, and even they are supposed to know that, and yet they will be very insistent that the BIS is absolutely right. Low interest rates have caused excessive risk-taking, and we need a Fed chair who's going to puncture this. I'm not asking you to comment on the Fed unless you want to, But I would ask you to say, given that kind of evidence you're able to present, is it just that market people have a cognitive dissonance in their head when talking to policymakers, they lecture and they invest differently? Or is it that the people who believe that lost money? I mean, make the point a little more explicit.
I think one way to explain this chart is that if you remember, half of the world didn't believe QE was going to be successful. QE, monetary policy in general, right?
Yep.
And so half of the world thought that was not going to work, that potential growth was permanently lower, and we are going to be in an environment of much weaker growth and much weaker growth of earnings in the real sector and all that. And so there has been a persistent negativity about the ability of the economy to essentially rebound. So in that sense, it has been a very big success of economic policy making. Right. Because we have been able to do, to essentially close the output gap in some places when nobody really believed it. And this has cost a lot of money to a lot of fund managers, right?
Can you move your microphone a little further up, please?
There.
Thank you.
So I think, now, it goes back, I think, to what we have learned, that maybe we have learned that economies are not self-stabilizing. And so if they are not, or if we don't know what the new steady state is going to be, if you get conflicting signals from policymakers, then it's normal that market participants and people in the real economy don't have much faith. And so they lower the confidence in that little formula that I show. And then you are discounting your assessment of the outlook, and you end up in a situation in which you just don't believe that there is value there.
Thank you very much. Now let me open it up to our audience. We have a traveling mic up front with Jessica. We have a standing mic in back. Please identify yourself when given the mic. That French-looking guy over there.
How do you know he's French?
Good.
I said French-looking. I don't know he's French.
You were right. Olivier Blanchard from the PIIE. Not surprisingly, I agreed with most of what you said. There was one point which I did not understand, was your argument that large excess reserves, average excess reserves, improve financial stability. I mean, I see the point of doing it where it's needed, but I'm not sure I see why, on average, it would be good to have large ones.
So I think that the line of argument there is that in the old days, you have excess reserves on demand, and now you have the excess reserves permanent. And the on-demand component created potential question marks about whether the reserves were going to be forthcoming. Whereas if the reserves are already in the system, there is no going to be the question about that. Now, of course, you can argue that excess reserves would create moral hazard, and it would diminish the, if you want, the market monitoring of the soundness of the different institutions. So you need to combine the excess reserves maybe with a more intrusive or a more effective level of supervision. But that's essentially the line of argument. When they did it in New Zealand, for example, it worked quite well, and I think at the end of the day, it's a better.
Yes, please. If you could just go to the mic standing in front of you.
Greg Yip of the Wall Street Journal. So you talked about the central bank should buy insurance on the outlook, right? And that it should be symmetric. So since at least the last time I can remember the Fed explicitly buying insurance against upside risk was in 1994 with very rapid tightening. And since then, it's mostly been buying insurance against downside risks. So first question is, what do you think of that? Is that creating an asymmetry to this situation that gets into trouble? And related, what would your prescription be right now? So we have a situation of below target inflation, but also very high asset prices and a very low uncertainty, at least if you look at things like low volatility. So exactly which risk should the Federal Reserve be positioning for right now, and what would your advice be to the Fed?
On the first question, I think at the end, I go back to the symmetry, right? So the Fed at the moment has too much anti-inflation credibility and maybe not enough anti-disinflation credibility if you take inflation expectations at face value. And it depends on what they want to do about the mandate, but I think that's the way they should be thinking about it. So again, of course, there is a potential time inconsistency moving forward because the leaders are not going to be the same ones in 10 years that they are today. But provided they have a framework that is consistent, then I don't see a problem that if for 20 years we had to cushion the downside, we cushion the downside. The same way that we are still, suffering, if you want, the effects of the very anti-inflation stance that we had to have 40 years ago. Now, the situation today for the Fed is tricky in that, on the one hand, there is a situation where inflation is below where I think it should be, and probably if I were there, I would be wanting to signal that I'm willing to overshoot inflation a bit to the upside to anchor expectations at the right level. But they want to do it in a way that doesn't create side effects. And I think it goes back then to the use of the forward guidance. So one way you can do it is you can have a more dovish stance without making excessive promises about it. And so you can still achieve the same level of real interest rates without triggering the negative side effect of promoting carry trades, if you want to call it like that. And again, I want to call carry trades, very broadly defined situations in which you make a decision not necessarily based on the value, but based on the certainty of the horizon. Maybe that's what they are trying to do. I don't know. But that's what I would do if I were there. Try to combine those two aspects so you can have an easier stance without running the risk of the side effect on the other side.
Thank you. Next question. Yes, please, Stephanie, and then at the back, come up.
Yeah, I agree a lot
Could
with
you identify yourself,
Yes,
please?
my name is Stephanie Griffith Jones. Hi, Ángel. From Columbia University. I also, like Olivier, agree with a lot of the main thrust of your argument. But I think even to be more convincing with your opponents, you really need to address the issue of the previous question of the bias towards increasing excessively asset prices, and also the impact on emerging economies, particularly their exchange rates, which I think monetary policy in the central countries has obviously an effect. Thanks.
I mean, on this, one thing I think I would like to say is that this concept that monetary policy should focus on the real economy and macroprudential and supervision should focus on the financial sector, we can say that so far seems to have been working reasonably okay. Of course, the proof will be in the pudding of the next vulnerability, but if 10 years ago I had told you that we were going to have negative real rates for 10 years, I don't think the reaction of many people would have been that 10 years later, credit growth was going to be underwhelming. And so what we have seen is been a parallel tightening, as I was trying to say before, of all the financial regulatory regimes. And I think that's what needs to happen. Now, one thing I didn't mention in the presentation, but I have in the book, is that I think that macroprudential should be part of central banking, not part of monetary policy, but part of central banking. Because you want to make sure that you have the right coordination between macroprudential policies and monetary policy. Now, if you do a better macroprudential policy, you can have a more supportive monetary policy. And I think that's very important. But that needs to be coordinated. So the countries that have this better coordination are performing better than the countries that don't have this coordination.
At the mic, you were on CNN last night, weren't you? Sorry,
Right.
go ahead.
Jacob Kirkegaard from the Peterson Institute. Now, Ángel, thank you for a very interesting presentation, and I shall refrain from challenging your this issue of central bank politics, other than note that it might be necessary for certain central banks in otherwise under-institutionalized currency unions to be able to play a little politics once in a while. But my real question is to something that I sense there is a little bit of an internal, I don't know, maybe it's just because I don't understand it, is between the need for the push towards a dual mandate or a growth-based mandate for central banks, and then the need to overshoot the inflation target at the same time, or raising the inflation target. Isn't there a sequencing problem? I mean, doesn't it at the very minimum, don't you at the very minimum need to reach your existing inflation target or even raise it before you go to a dual mandate or a growth-based mandate? Because otherwise it becomes less easy, or it becomes harder for the central bank to overshoot.
let me try to explain myself better a bit, like you did yesterday with the Danish healthcare system. What I'm trying to say is the following. If you only focus on inflation, you run the risk of achieving a lower level of demand, simply because when you have inflation that has very little sensitivity to demand, so the Phillips curve is very flat, then my recommendation is that you should constantly be testing the limits of growth, right? Because you don't know. And because that sensitivity is, there's always more room for you to achieve it. What do we know whether the NIRO today in the US is 5, 4.5, or 4? To be honest, I don't think anybody has any idea. We will know it when we see it. And so all I'm saying here is that if we believe in the possibility of hysteresis and we believe in the possibility of very flat Phillips curve, then I think the responsibility is to continue to test until you see the impact. And why do I say that? Well, in this case, there is a double benefit. That is, I do want inflation to overshoot so we can reach that higher inflation target. So when we test it and we get there, inflation will move up, and then we will have been able to shift to the next regime. So yes, there is an issue of sequencing if you want, but I don't think it's incompatible in that sense.
I would just interject here. About 20 years ago, there was a small book published from what were called the then Alvin Hansen Lectures, which had Bob Solow and John Taylor debating monetary policy. And again, this was 20 years ago, and Bob Solow made a call for being experimental in just the sense Ángel said, that there was no real harm for any central bank, obviously in a credible price stable environment like the US or Europe, in being experimental since it didn't know where the neighbor was. And he wasn't relying on hysteresis arguments at the time, which I would think would even more underscore that. I would also point out that at the time, 20 years ago, John Taylor was, of course, against any form of experimentation or pushing downward on the unemployment rate, but that may not be of any relevance. Please.
Jeremy Quinn.
Then right there.
Jeremy Quinset and Peterson Institute. So one difficulty for the ECB right now, after the crisis and for the upcoming 20, 30 years, is that it has to operate in a political environment where there's always going to be that risk that a party who has a platform calling for a referendum on exiting the monetary union or exiting the EU would gain power. And so I really wonder if you have a view of, what the appropriate response of the ECB should be if such a situation arises.
That's a tricky one. I don't have a strong view, to be honest. That is a political decision. And one point I also try to make in the book, right, is that independence is in the eye of the beholder, right? You achieve independence if you are politically savvy and you can achieve a good understanding with the political authorities, right? That was Alan Greenspan at the end of the day. And so in a situation like that, it will depend on the specific case. I think then at that moment, the ECB should be trying to have the right policy setting for the euro area as a whole. And that should continue to be the most important part of this mandate. Then you will need to see about what the specific issue is and then maybe adopting, specific policies for that. But I don't think there should be a situation where the ECB should be taking the eyes of the mandate here that is maximizing economic growth and achieving price stability in the euro area as a whole.
Okay, please here.
Joe Beaulieu from Bremen Howard. I wanted to thank you for the excellent presentation, and I wanted to just challenge and ask you a bit about what you mean by symmetry. So first of all, let me wholeheartedly endorse the idea that monetary policy has been very successful in bringing output back up, lowering the unemployment rate. And in that way, we lowered interest rates and then went on to QE and some other things. But what is it in your mind, what symmetry means when I cannot name a single time when the central bank has successfully brought the economy back from a point where it was arguably operating above its potential. I mean, it has raised the unemployment rate in the past, but none of those times would I say it was actually successful policy.
I'm trying to think. I'm trying to think of cases in which it has happened. You are right. I mean, it has happened in other places. You know, Australia has had a 16, 17-year-long expansion. I accept the challenge. I think we are in a situation in which now it might be easier to do it. We have a way tighter financial regulatory regime that can keep the financial excesses a little under control. And we have a situation in which, if you look around, there are no imbalances anywhere. You think about the US economy, and in general, it's difficult to find obvious imbalances. So now it is a question of keeping it going steady at around potential growth rates. Well, maybe that's what has happened the last 7 or 8 years, right? We've been, the US economy has been growing at around 2% on average. And I would say that what has done there is to grow a little bit above potential, but not much more than that. So it is a challenge. I don't deny it. But I think we are in a situation today where it might be easier to achieve.
The gentleman over there, please. Yeah. No, she's bringing you the mic. This is the incentive for all of you to sit further forward. Then you get the nice mic handed to you. Anyway, please.
Thank you, Angel. Great presentation. Gianmaria Milisi Ferretti, IMF. I wanted to hear a bit your views on the weakness of inflation. So one can say, well, it's mostly that a series of unfortunate disappointments on activity after the GFC have brought down inflation expectations. That's what your charts show. It's really an issue of bringing up inflation expectations. The Phillips curve is really, really flat. So it's not so much an issue of bringing the economy a lot above potential. It's just that you need to convince people that you're doing something different. So mandate nominal wage increases. Another view is complementary, I would say. There is more slack than it looks. So yes, a lot of part-time, involuntary part-time, maybe not so much anymore in the US, but in many other countries, we have measures of output gaps, which look pretty small to many observers in countries that had massive recession, Spain being one. So the idea that you close the output gap of the euro area in a year or two, when you have 17% unemployment in Spain, 11 in Italy, 9 in France, seems a little bit overgenerous. Third, is it that maybe there is something else going on that you have, despite the fact that the Phillips curve somehow still exists, that wage dynamics do behave differently depending on the unemployment rate, you have some other global factors, more mobility of capital than labor, a shift in bargaining power away from workers, that somehow prevent those natural pressures of tightening labor markets in manifesting themselves in higher inflation because, say, leading sectors are those typically more at risk of offshoring. So just like to hear your views on this. Thanks.
Well, it's I don't have a strong view one way or another, but I can make a couple of points. I think one is that if you think about the way we look at inflation today, there is a clear conviction that it's not going to be a problem for the foreseeable future. And that is affecting decisions.
Not going to be a problem in the sense that it's not going to shoot up.
In the sense that it's not going to increase. I'm sorry, you are right. That's what I meant, inflation, not disinflation. But that's exactly correct. So you can see that in the negative term premium that you see in financial markets. Oh, sorry. Okay. You can see that in the negative term premium. So essentially, markets are telling you that they are not willing to pay any money to hedge against inflation. And that, I think, is generating a sort of a spillover effect into many other decisions. Now, one thing that is interesting is what you were mentioning about the labor market. I think it's quite possible we have settled in a new equilibrium for the labor market where workers prefer to have jobs rather than wage increases. So labor security is priced more highly than the expectation of an increase in wages, and it could also be related to the fact that people don't expect a higher inflation in the future. This has been the experience in Japan, frankly, and it's quite possible we are starting to see that in the developed world as well. Another factor, if you want, is the widespread, the beginning of seeing a lot of business models out there that are focusing on market share rather than on profits. Take Amazon, right? Amazon is not important because it sells at a lower price. It's because they are not necessarily seeking to maximize profits in the near term. And that is putting downward pressure on firms, and it's putting pressure on firms to essentially try to preserve market share. Now, that is possible, among other reasons, because interest rates are very low. So you can finance a lot of your operations at a cheaper level. So I don't know. I think it's a combination of many factors. And I do believe, as some people have been saying recently, that if we continue to stimulate demand, we'll end up having inflation. I don't think the deep mechanism of inflation has disappeared. But I do think that we need to continue to stimulate demand.
Terrific. I'm afraid I'm going to have to cut it off there. We're at our closing hour. Thanks to all of you online around the world who joined us. Thanks to all of you who joined us in person for this fascinating discussion. Again, this is by Ángel Ubide, currently of Goldman Sachs Private Wealth Management, formerly senior fellow here at the Peterson Institute. I'm proud to say we're delighted to have published The Paradox of Risk, Leaving the Monetary Policy Comfort Zone. Thank you.
Thank you.